One of the key features of interest rates really for 2018 and even part of 2017 is this notion that a good aspect of their behavior is already baked in the cake. Very few retracements, a Fed that seems undeterred to normalize, and we could all debate how much more normal and how do we get to neutral and what is neutral. Will we recognize it when we get there? All these things are very important, but some things changed this week. Call it a cumulative effect. Finally, Treasuries are taking notice not only of the volatility, but the direction of the volatility in the equity markets. And the charts bear that out. As a matter of fact, not only do they bear it out, they pretty much will let investors know where you really need to be most cautious. So let's go to the board. We start this chart on May 1st because there's about 10 trading days in May that gave us all the clues for the rest of the year in Treasuries. And of course, what I'm referring to is around the 17th when we made the first high yield close of the year at 311. And things happened quickly. Between the 17th and the end of the month, the 29th, you covered a lot of ground and you made what I call the most important bottom of the year at 278 because the market jostled. You remember how crazy it was in February. It moved around, but it never traded on a closing basis any closer than 281, which means that it should hold all retracements. So after we made the 323 high, and if you go across to the 311 high, what you'll find is today is the day it looks as though we're going to go through that level. Now, Wednesday we closed at 310. Listen, it's not rocket science. Give me a little slippage on 311. But the point is, if we now close below that high, unlike how we behaved on the key bottom, things could change a bit. But also remember, stocks aren't closed and the Treasury market isn't closed. But I give it 3 basis points. So anything under 308, most likely, we're going to go back and test 3%.